The rent covers the mortgage. So why are Priya and James still debating whether to keep the flat or finally sell it? It used to be their home. Now it has a tenant. It brings in £2,400 a month. And there's roughly $325,000 of equity tied up inside it. On the surface, there seems to be no urgent reason to sell. But the mortgage is only the most visible part of what this property costs them. The rest arrives at different times, in different places, and some of it never appears as a bill at all. Once you see the full price of keeping that flat, the decision looks very different. Not necessarily easier, but much clearer. Let me show you the household. It's an illustrative household in England, based on patterns I see again and again, not one specific family. Their family home is worth £1.3 million with an £800,000 mortgage. The former flat is worth £600,000 with a £275,000 interest-only mortgage. Combined, they own £1.9 million of property with roughly £825,000 of equity before selling costs and tax. Priya earns £160,000 a year from her employment, but she wants to leave a job that no longer fits her life, and the household still feels dependent on her salary. That creates the deeper question underneath the property decision. Why has owning something that has made them wealthier not made them freer to choose? When Priya and James outgrew the flat, keeping it made sense. Selling it first would have meant waiting for a buyer before they could commit to the family home, a chain that could take months and put the purchase at risk. Property also felt tangible, something they understood, in a way a stock portfolio never quite does. The rent seemed to cover the mortgage, and they could afford the new property, so where was the harm in waiting? Nothing about that decision was careless. Many households in this position would make the same call. It's also a common position to be in. Government figures show that more than a third of individual landlords originally bought their first rental property to live in themselves. There's also a cost that's already locked in whether they like it or not. When they bought the family home, they paid the higher stamp duty surcharge that applies when you own more than one property, on the assumption that they'd sell the flat within a few years and claim it back. 3 years came and went, 2 demanding jobs, 2 children, a full life, and the normal refund window closed. The urgency has gone, and with the property's value remaining flat, it never feels like a good time to sell. There was also a quieter reason, a common one. Plenty of people who move out of the city keep the old place, telling themselves they might still need it, somewhere to stay after a late finish at work, or a flat for the kids one day if they end up studying or working in London. It's a good location. That's hard to give up. So far, keeping the flat looks rational. Its benefits are easy to see. Its costs are harder to see because they arrive at different times, in different places, and some are rarely priced in at all. The mortgage is monthly. The full cost of keeping the property isn't. The flat brings in around £2,400 a month, £28,800 a year. Using an illustrative interest rate of 5%, the interest on its £275,000 mortgage is roughly £13,750 a year. So at first glance, the flat appears to produce more than £15,000 a year. But that is not what reaches Priya and James. First comes the tax calculation. For an individual landlord, mortgage interest is no longer deducted in full when taxable rental profit is calculated. Instead, Priya receives a basic rate tax reduction. So she can still face a meaningful tax bill even when relatively little rental income is left in the bank. Then come the costs that arrive on completely different schedules. Service charges and insurance, preparing the flat for a new tenant, safety requirements, repairs, weeks without rent, and a product or a remortgage fee whenever the financing needs renewing. No single cost necessarily destroys the investment case. It's the accumulation that matters. In an ordinary year, the flat may still produce a modest surplus, but one repair, one extended void, or one expensive refinancing can turn the surplus into a gap that needed to be filled from their salaries. So the property requires continued income to absorb a difficult year, cash reserves for repairs or a long void, and their attention whenever something goes wrong. The rent may be paying the mortgage, but that doesn't mean it's paying the full price of the flat. The flat contains around $325,000 of equity before selling costs and tax. That's the capital this decision is really about. The moment Priya and James moved out, the flat stopped being their home and became an investment, even if it never felt like one. Keeping it means concentrating $325K in one property with one tenant in one postcode. Leverage is part of what made property so powerful for them in the first place. A smaller amount of their own money gave them exposure to the growth of the whole property. But it cuts both ways. Keeping that exposure also means carrying the mortgage and the interest rate, cash flow, and refinancing risk that comes with it. And there's the opportunity cost. Selling could allow them to diversify the proceeds, reduce the $800,000 mortgage on their family home, or keep part of the money as a runway while Priya changes careers. So the invisible cost isn't one number. It's the concentration risk, the income reserves, and attention the flat requires, and what the £325,000 could make possible somewhere else. What Priya and James are really weighing is what I call the option price, what it costs to keep a choice open rather than to make it. Every time they remortgage, they aren't simply refinancing a loan, they are buying another period in which they can keep the property, wait for their plans to become clearer, and avoid making an irreversible sale. To work out whether that option is worth the price, ask 3 questions. What is the property preserving? What does keeping it require? And when will you decide again? And after working through all of that, you might assume that I think they should sell. But when my family faced a version of this decision, we kept that property, a decision that surprised even me. When my family relocated abroad, we kept our UK home and rented out. With a newborn and 1,000 things to manage before the move, realistically, managing a sale wasn't going to happen. So we rented it out and got on with it. When the fixed rate was about to run out, we realized just how complicated and expensive it is to remortgage a UK property from abroad. Financially, there was a strong case for finally selling. The capital could have gone somewhere more liquid and diversified. Instead, we decided to keep it. That home wasn't just a rental. It was a landing point, a familiar neighborhood, schools we could still consider, and our favorite parks and cafes. The new term lined up with when we'd know about our next move and our son's school decision. And managing a sale from overseas on a high tracker rate with possible renovation costs and extended void periods would have required more cash reserves than we had at the time. So we remortgaged on purpose because we knew what those 2 years were for, what keeping the property would require, and when we would ask the question again. Back to Priya and James, let's run their situation through the same 3 questions. What are they preserving? Not their ideal family home, they outgrew that, but access to a familiar area and somewhere to return if their plans change. What does preserving it require? In an ordinary year, a thin surplus, but also reserves for maintenance and running costs, ongoing attention, and the opportunity cost of £325,000 concentrated in one asset. When will they decide again? That's the question the mortgage renewal is forcing right now, whether they engage with it or not. There's no right or wrong answers to these 3 questions. Selling and redeploying the capital is reasonable if that flexibility and diversification matter more than what the flat is preserving. Keeping the flat is reasonable if its financial and personal value together justify what it costs, the cash, the concentration, and the attention. And there's a third path, remortgage for one more defined period, with a real cash reserve set aside and a predetermined date to ask the question again. Here's the answer to the question we asked earlier. Why hasn't owning something that made Priya and James wealthier made them freer to choose? Because the wealth is real, but it is held in a form that still requires income, reserves, and attention to maintain. The flat isn't the only reason Priya feel unable to change careers. But keeping $325,000 tied up there while carrying an $800,000 mortgage on their family home means their wealth isn't currently reducing their dependency on her salary. And because the flat used to be their home, it never felt like a purely financial asset. It still carried history, security, and possibilities for the future, even after it had effectively become a $325,000 investment decision. Your version might not be a rented out flat. It might be stretching for a house that improves family life now, but leaves less room to change careers later. Or paying down a mortgage for certainty at the cost of access to that capital. Every major property decision secures something you value, while committing money that could have supported another choice. That doesn't make property wrong, but property commitments are unusually large, illiquid, and slow to reverse. The benefits are obvious, but many of their costs reveal themselves gradually. You don't need certainty about house price to move forward. You need to know what the property gives you, everything it requires from you, and whether that exchange still supports the life you want now. If you want a calm framework for decisions like this, my book, The Compound, is the easiest next step. And if you'd rather talk through your own numbers, I've linked to the current ways of working with me in the description. Property is one way wealth can stop being flexible. Next time, a different one. What happens when the income itself doesn't arrive on a predictable schedule? Thank you for watching. I'll see you in the next one.